So I welcome you to our today's session, the money and banking class, and we'll start with the money issues, where by different authors we see the definition about money. Uh, and I like the definition brought in by Walker because as it is at the moment, you realize that we feel money when it has done something for us. We appreciate it when we are able to buy a number of items that we want to, of course, depending on our desires, of course, depending on what are our aspirations as human beings. When we are spending money, we want to feel that particular strength of it by now being able to purchase a commodity. So Walker presented the definition about money as to what that money does. What money does. And I believe we are all in the search of a better life where we are looking to getting that particular money that can do all the things that we want to in our lives. The strength of it will be seen by what it will have done in our lives. But again, we see a definition brought in by Grother. Grother conforms to what most of the modern economists have presented, that money is anything in regards to what it will do when we are exchanging, anything that will be acceptable as a medium of exchange. But of course, there must have been a debt. I give you a commodity known as A, so it means you have a debt to honor by now paying, of course, through different means. You may also provide me with another commodity, like what you'll see as under the barter system. But if you pay money and I accept it, then because it has settled that particular debt, we recognize it as a medium of exchange in the society. So you see, definition number one, as brought in by Grother, he's one of the modern economists. And again, what many economists have proposed, you realize that they are providing the same kind of a definition, the medium of exchange, meaning it will be generally accepted in the settlement of the debts. A brief history about how money came to be. You realize that before the introduction of money, societies used to trade under what we call the barter system. And traditionally, there used to be what we call the commodity market, where people would go and have different commodities. And in this particular market, you'd exchange a commodity for another or a service for another. And in the commodity market, salt was seen to be of great value because of its importance, for example, in relation to the preservation of something like meat. Traditionally, people used to do hunting, so it means one of the most common foodstuffs was meat, and salt was seen as a major element that could help to preserve that particular meat. So in any case, you had salt, you'd use it like the same way we use money in acquiring other products in the society. And later on, there was the discovery of some metals, for example, silver in the society, which was of a greater value, also bronze. And these were now recognized as a medium of exchange, that whoever had silver, whoever had bronze would use it as a means of now acquiring other products in the society, just the same way we do use money today. However, in the discovery of the metals, there was the feel that gold was of a higher value than any other of the other two that we have talked about, which now people felt they were not safe to keep it at their homesteads. And therefore, in the Goldsmith Bank, people were encouraged to deposit their gold. They be issued with some receipts, which they could now use to acquire other goods and services in the society. In the issuance of the receipts, once somebody has deposited the gold in the Goldsmith Bank, there was now the need of recognizing the worth of that particular receipt with some value. And that's how now the transformation of the receipts that were issued under the Goldsmith Bank came to be the paper money that we see today in circulation. The receipts that were issued, there was a need to recognize them in different units, and such units were now the ones taken to define the amount of any currency that could be trading in the society. Again, silver and bronze were still found to be of a higher value in the society, and they were now transformed to be for the minting of the coins that we normally see in circulation today. So that is a brief history about how money came to be. It's all started from the commodity market, where something like salt was of a greater value, which could be used as a form of exchange for the various goods and services in the society, just in the same way we use money today. Then the discovery of the metals, which were of a higher value in the society, were noted to be a contributing factor whenever somebody wants to exchange for a particular commodity. But those metals, even up to today, they still have a higher value, and they're the ones that have been transformed to be the coins that we see in circulation. Gold, which was of a higher value, due to the insecurity reasons, the Goldsmith Bank was opened, and people were encouraged to take their gold there, where they could be issued with some receipts, where these receipts would now be used in the exchange of other goods and services in the country. But because a receipt would be of a higher value, maybe beyond the commodity you want to acquire, there was a need now to actually divide those particular weights of the gold into various receipts, which were later on now transformed to be the paper money that we see in circulation, for example, in our country today. There are some terms which people may find confusing when you're defining what is money. It is important that we distinguish this from other two terms. One of it is what we call near money, and I would say that near money is anything that can be highly liquidated, that which you can easily convert into cash, and of course you meet your transactions. That is what we can call near money. It is not cash form, but can be quickly converted into cash within a short period of time. That is what we can call near money. A good example is what we call the Treasury Bills in our various banking halls. Somebody would go and a Treasury bill can be converted within a very short period of time into cash. And of course, you can now go and meet your transactions. You can go and exchange for other goods and services within that short period of time. The bank deposits, assuming you have a savings account or a current account that you're operating, it is possible for you to get cash within a short period of time. For example, through the ATMs currently, people can rush into an ATM point and get cash within a very short period of time. That which we are able to convert into cash, M-Pesa accounts, for example, also, you can be able to go to an M-Pesa agent and withdraw money within a short period of time. You have your cash with you, you can always call it near money. And of course, to some extent, people may agree to have the debt settled through, for example, M-Pesa as you send it to me, because I can always convert it into cash within a short period of time, then I can also accept it as a medium of exchange. Money substitutes. These are also non-cash forms, but they are also accepted as medium of exchange in our society. But it doesn't take a short time for one to convert it into cash. It may take a number of days. A good example is what we call checks. Checks can be used as a medium of exchange. People can be able to settle debts. I can accept your cash, for example, I can accept the check, say a banker's check, because I know the moment I take it to the bank, it can be converted into cash, though it is not going to happen instantly. This may take a number of days. So money substitutes and near money are also forms of recognition that people can be able to settle debts, but they are non-cash forms in our society. Before we look at the functions of money, I would want us first of all to look at what we call the barter system. And we see the shortcomings or the problems that were associated with the barter system, so that when we'll be introducing money, we'll be able to see money as a solution now towards the barter system in a society. What is barter trade? Barter trade is a form of exchange of goods for goods, services for services, of course, services for goods, and even goods for services. I repeat, this is a form of exchange where we don't use money. We have the exchange, for example, for goods, maybe goods for others. Maybe you use a good to acquire a service. Maybe you use a service to acquire a good, or even you can give a service in order to acquire another service. And barter system, as much as we have said today, we have the introduction of money in our country, it is still playing part. Many are the times when people would still recognize the efforts by each other, and that is a form of exchange also. Or I can give you a product, you also give me a product. So in return, there is no involvement of money, and so we can say an exchange has taken place, and by so doing, we recognize the existence of the barter system even up to today in our society. Okay. Now, the barter system was full of challenges before the introduction of money, where, an example, I may have a commodity known as A, and I'm looking for somebody who has B, who intends to get my A. I may take a long period of time in search of that person whom we can exchange our products comfortably. You have what I'm looking for, and I have what you are looking for. That may not happen instantly. There is what we call lack of double coincidence of ones. Lack of double coincidence of ones. And one may search for somebody for so long in terms of trying to get that who has the commodity that you can be able to exchange with comfortably. You might find you're taking too long to get that particular person, which now complicates the process of the exchange. In other words, the trade may not take place. Most of the commodities traditionally, remember we are talking of agriculture like in Kenya and within the African region, being the most important, and of course being the most treasured kind of a line of production. So most of these products were perishable. They couldn't be stored for a long period of time. So in search of, you keep on trying to get somebody, for example, you have your cabbages, you want to use them for the exchange of maize. You find that along the way, as you're searching for somebody who can get your product, then since there's no proper storage in our stores, they are actually not having good ventilation if they are there. Then you find we have problems to do with the pests and diseases still in our stores. So all those challenges would pose a problem to somebody who wants to exchange with another product, but now yours is perishable in nature. And if today we can sell off our products, I think money can be stored for a long, I don't know, a long, long time, and therefore, without going bad, one may use it to, of course, meet as many transactions as possible. Determination of the value. What is the worth of the product that you are holding? Is it the same as mine? If today we have prices designated for the various products in our various stores, how would one now define the prices, for example, which are not in existence in regards to now defining the value of a particular product? I think it was a difficult thing to do in relation to the barter system. And one may end up getting a product which is of a higher value when he has given out a product which is of a lower value, meaning such products are not actually sharing the same weight. And in this regard, it means somebody along the way ends up losing in regards to how the products are written, because we are not able to tell the exact value, the exact worth of the product. One may end up gaining more and another one losing in the market, which is not a good thing, of course, when you have worked so hard to get the product and then you don't get its value. It isn't something to enjoy, especially as a business a person or even somebody who is in the business. Now, we are talking of lack of a good way of determining the value of a product. And this is posed by the indivisibility challenges. As a result of, you cannot be able to divide a product into smaller portions. Look at this, we're talking of the traditional way of living. So you can imagine you want to trade with your cow. Would you divide your cow into portions so that you can get a bag of maize, or you can get another product which is of a lower value than your cow? So you find that indivisibility issues were the ones that were bringing about problems in terms of we cannot be able to rate the value correctly for a given commodity in the society. Now, you have gotten my product. How do we agree in terms of the payments? Yeah, how do we come and define how you're going to pay me back when you have taken my product? If you say you have taken a product worth of, let's say, 20 shillings, today we can agree you'll be paying me 1 shilling every day until 20 days are over to have cleared the debt, maybe plus some interest that I'll charge you. But in the traditional way now, we are talking of products that were not divisible. And now, defining how you'll end up clearing the debt becomes a challenge. So you see, point number 3, point number 4 and 5, they are all connected in that because of the indivisibility issues, one may not be able to determine the value correctly. And as a result, even how to clear the debt, yeah, you find that it is difficult. And therefore, we say there lacks what we call the standard of deferred payment in any case somebody has a debt on a given commodity. Now, because you have seen the challenges that were brought in by the barter system, these challenges will find a solution with the introduction of money. And we want now to look at the functions of money in the society. Number one, as from our definition, which was proposed by Grother and supported by the modern economist, money acts as a medium of exchange. But our question today is, once I've delivered my services, for example, at the price of my work, KCA, why would I accept the 20 shillings that I'll be paid at the end of the month? Why do people accept money when they have let's say, given you a product known as sugar or anything else, why accept money as a medium of exchange? It's because money will be used to acquire other goods and services. Once I'm paid for the services that I'm rendering, I'll also use that particular payment, I'll use that money in acquiring other goods and services that I need in my life in our society. So people accept money as a medium of exchange for the goods they are selling, for the services they are rendering, because they'll also use the same in acquiring other goods and services in the same society. Stall of value. We saw a case where traditionally most of the agricultural products that were used in the exchange would go bad within a short period of time. Now today, after you harvest your cabbages, you can take them to the nearest marketplace and you sell off your cabbages, you can keep money for a long period of time, which means money can be acting as a store of value in the society, so that in return, one can be able to use this particular money, say in the future, to acquire other goods and services. Measuring units of account. Whenever we have a business, for example, one can be able to say, my stock is worth of this much, because there's a price attached to everything that is available in that store. And in the same way, people can be able to assign a given value in relation to, for example, what they have. They can be able to value the things that they owe in a society, of course, by assigning a given figure, a given price on the commodity that they could be having. And therefore, money can be used as a unit of account. And I would also say, in the same regard, one can be able to define the wealth based on you are able to design the value of a particular commodity, and the same can happen to different properties. And so we can be able to say the worth of a nation, the worth of an individual in terms of what that person could be having is this much. And upon that, we can be able to say what is a worth of a business, how much do I have, and my wealth is this designed to be like this, of course, based on the values of the various items that the person or even the nation itself could be having at any given period of time. I remember during the time we were discussing about the topic of farms theory, we introduced the factors of production. And when we were discussing about land, we said land is a fixed factor. It is a primary factor supporting everything in a society, but it is not possible to move a piece of land from where it could be physically, the location being permanent or being fixed. One cannot be able to move it, meaning it is an immobile factor of production. But we also said if we are able to improve on the mobility of the fixed factors of production, productivity of a nation is likely to be high. Therefore, money can be involved in the transfer of a piece of land from one region to another. In the movement of that piece which was fixed, you can sell it off, use the money that you'll get from the sale of that piece of land, go elsewhere, maybe in a place which is more productive, and you can establish your business elsewhere. Meaning, money, one of its functions is that it acts as a way of moving the immobile factors. A good example, land, or even buildings. You can sell off your building other than demolishing it. You can sell it off and then you go and build another in a different location altogether. Today, when you get a particular amount, maybe you're required to pay it back, say a loan, you can always agree with the lender, be it a bank or any other person that is considering a lending activity between you and that other institution or that other party. In any case, you have taken that particular amount, you can agree over which period of time am I supposed to clear this, the terms and conditions stipulating how much should I be paying you regularly until I'm able to clear that particular debt. This shows that money acts as a standard of deferred payment. And you see now in the discussion of the functions of money in our society today, we see a solution now coming, of course, in fighting the challenges that we saw in regards to the barter system. Money acts as a medium of exchange. Money acts as a store of value. Money acts as a unit of account. We can be able to measure our wealth based on money. Money acts as a way of moving the immobile factors such as land and buildings. It helps to improve their mobility. And money also acts as a standard of deferred payment in a society. What are some of the features that good money should possess in a country? The characteristics of good money in a society. Money, as we had said, it acts as a medium of exchange, and we questioned, should I accept money whenever I have rendered my services? Should I accept money whenever I've sold a commodity to you? Yes, because money, which is acceptable as a medium of exchange, could be useful in now acquiring other goods and services in the same society. And therefore, for us to accept money, it means itself must be acceptable. Acceptability is one of the major factors in the society that one should be able to accept it as a medium of exchange. We should be able to accept money as a medium of exchange in the society. Number two is the convertibility, assuming you have the dollars and you want to spend them in Kenya. Does it mean that you not spend the dollars in Kenya? No, because there is availability of the foreign exchange. And I remember I threw a question to you on Friday, asking ourselves whether it is important to build up reserves in relation to the currencies of other nations in the world. Is it of importance to have the dollars in Kenya? And when we realize that the dollars available, the level has gone up to a certain point. Let's say we only have $2 left. Is it of importance for us to say such an amount will not be issued anymore? If money cannot be converted from one currency to another, as we were talking of the international trade possible in a country, that means that will not happen. So it is important that whichever the currency the nation is considering to issue to get into circulation, it must be convertible in the country from one form of currency to another. Divisibility. You go to a shop with, let's say, 100 shillings, you buy a product worth of 10 shilling, you should be able to get your difference, which is the 90 shilling, meaning money can be split into as many smaller units as possible. Of course, this is to facilitate many transactions to be possible with a given amount in our society. Durability. For how long should I hold a given amount without it getting, for example, bad, like in case of a cabbage or any other perishable product? Money is durable in nature, and so can last for a long, long period of time as long as you keep it in a good condition, especially the paper money. Then you'll realize that it can last for a long period of time. Stability, we don't want to be holding money and now and then it's losing its value, maybe because of the high level of inflation in the country. We want to have our currency building trust in our people's daily life. We don't want them to be losing that particular trust now and then, because whenever we go to the shop, if I am holding 100 shillings today and buy a basket worth of some items, tomorrow I go, I can't even buy even an item which was in my basket yesterday, then people will start losing trust. When we'll be getting into the discussion of inflation, there is that inflation we call hyperinflation and another one called a rapid inflation. Those are very harmful to a society. They even reach to a point where people of the nation are calling for a change in the currency and can even bring about instability in the same society, where for a particular society, it's important to build that trust on whatever is trading, because it also attracts a chance for people to venture into different forms of investment in the same society. And it also promotes such kind of a motivation that whenever I'm working hard to get a given amount, I know in the next 2-3 years, I can even plan on how to spend that money. The consumption levels are also likely to be stable. We'll discuss further in regards to inflation, and when inflation is too high, that is not actually a good thing in a society, because it can even deteriorate the level of growth and also development in the same society. Portability, how heavy is money when you carry it from one place to another in regards to you now carrying out transactions, yeah? It shouldn't be something that is too heavy to transact with from one point to another. And it's easier way of moving from one point to another with it to, of course, carry out transactions would facilitate as many transactions as possible in the same society. Scarcity, of course, for us to work hard and to think of as uh, many activities possible in a country, it is important that money is not going to be plenty, that its scarcity facilitates the growth in a society, because if money were to be all around, that when we move around we can grab it easily, then people will not be undertaking economic activities. And when we have got no activities in our society, that would actually deter the level of the growth in the same society. Uniformity and homogeneity, these are the appearances of a given amount. Say you all know how a 1,000 shillings in Kenya looks like. So whenever I present my fake money, it's possible for you to detect, and of course, you not accept it as a medium of exchange. So the homogeneity point normally is to reinforce the fact that for people to trust and to accept, then this whatever is trading, the material, the uniqueness of a given currency needs to be noted in the society, so that people are able to tell what is a real and that which is fake, of course not to accept it as a medium of exchange. Cognizability is another feature that one should be able to recognize if it's a Kenyan currency, as it trades within the Kenyan rand. One can be able to tell that this is okay to accept and that which you can't accept. For example, the fake money or any other currency that you know you can't be able to trade with in the country. So those are the features which actually supports the money that we see in circulation today. And that was our first part of the discussion about money, the relationship that money has with the barter system, acting as a solution towards the barter trade in the country. And of course, we have also talked about the features that money is supposed to possess in the country. The distinction between the money, the near money, as well as the money substitutes is also very important for us to consider and to be well understood, that when you're talking about money, that is anything that is generally acceptable as a medium of exchange and itself can be in form of, let's say, near money or even money substitutes. Those that are not necessary in cash form, but we see them being accepted as medium of exchange trading in our society. Our part two of our discussion is to look at what we call our second discussion involves us looking at the demand as well as the supply of money. We are going to start with the demand for money and then we look at the supply of money. In this particular discussion, we are going to be guided by some theories which actually look at the way people would want to hold on to money, especially one of the discussions that we are going to see by the John Keynes discussion, where he's looking at a situation where I want to have cash with me. I don't want to spend it. I don't want to invest it. We are going to see the reasons behind people holding on to money. So in the demand for money, we are looking at the side of somebody who wants to have money. And there are three theories that we wish to discuss. One of it is what we call the quantity theory of money. This was proposed by one of the statisticians and an economist known as Alvin Vischer. And he has an expression which was first of all developed by another economist, where in the discussion of how money circulates in a society, we also look at the price of the various goods and services. And this particular theory, the quantity theory of money, emanates from the discussion between the money that is in circulation, also known as the money supply, and the price. Now holding all the other factors constant, so I'll use an element known as A. And this particular discussion shows that whenever the price of the commodity changes in the society, it has been as a result of the increase in the money supply. That if money supply changes, the prices of goods and services will also change. I buy the idea because in any case, people have a lot of money. You find that the demand for the various goods and services increases in the same society. And this actually pushes the prices of the goods and services to increase. Under normal circumstances, when there is high demand for the product, the prices tend to increase in the market. A good example, like when people are going for Christmas, of course, they have accumulated enough to a point where during Christmas time now, they are able to spend that money. And you find that as they are traveling from one point to another, since the demand for travel is high, then the prices, the charges, the fees, the bus fare also gets to be high. Money circulation, by belief by Taoism, this development by Alvin Vischer emanates from the Taoism's discussion. Taoism is one of the modern economists, and in his view, he would see that whenever the money supply doubles in the society, even the prices of the goods and services in the country would also double, but now holding all the other factors constant. So the A that I'm setting here is that by any other factor, we are holding them a constant. Now, in the development done by Alvin the discussion held by Alvin Vischer, we see that there are other aspects that need to be put into consideration. Number one is what we call the ferocity of money. In other words, how money circulates in the society, and also the number of transactions that we're able to undertake with a given amount of money. And by holding the ferocity, the V, and the transactions constant, we go back to the discussion that was held by Tausim, where he sees the money supply, that is the M, and the price, that is the P, having a relation. That every time money supply doubles in the country, the prices of goods and services will also double. So Alvin Vischer brought in the aspect of the ferocity, how that money changes hands, how that money is circulating in the society, and now the number of transactions that with a given amount one can be able to meet in the society. Of course, relating the amount of money supply with the prices of the goods and services that one could be considering to buy in the same society. Now, for this particular theory to hold, there are some considerations that we need to make. So for this theory to hold, one, we need to consider that the number of transactions, the T, are going to remain constant. Number two, the ferocity that we are also talking about, how money is changing hand, is also going to remain a constant. That is, in any case, we want to relate the price and the money supply in the economy. The relationship between the general prices of the goods and services and the money supply, or the quantity of money at hand, how they are related, then the P that we have talked about, and the M, to have found that relationship, the V and the T have to remain a constant for this equation to actually play its role in the society. Also, in regards to how the government's policies are in the country, we need not to have a change in those policies in the society. For example, if the government is, say, changing the prices, maybe because there's a maximum or a minimum price, such a policy by the government needs also not to be taking place in the country. In fact, we can add it as point number 4 on your handout, that the government's policies, point number 4 there, the government policies in the country need to remain constant. A good example, we need not to have a change in the level of the price controls. We need not to have a change in the level of the subsidies, because if that happens, then prices will actually change. So the relationship we are drawing between the money supply and the price of the commodity in the market should be by the forces of the demand and supply, that these prices should not be changed by the other factors. It should only be by the forces of demand and supply in the market. Is it true we can't see the screen? Class? Eric, you can confirm for me.
I can see from my end.
Is my screen not visible?
It is.
Okay. So we are saying that the equation presented by the quantity theory of money, which was presented by Alvin Vischer, emanates from Tausim's discussion that the money supply relates to the price of the commodity, where as the money supply increases, the prices of the goods and services would also increase in the society. And by, for example, doubling the money supply in the country, the prices of the commodities will also double, but holding all the other factors constant. So the A that I've indicated here represents that other factors are held a constant. And those other factors are what now Alvin Vischer brought into the equation, that is the ferocity and also what we call the number of transactions. And for the equation to actually hold in a society, we have the considerations that one is that the number of the number of transactions that we are talking of, say with a given amount of money, they have to actually remain a constant in the society. And the same, the way money is circulating in the country should also remain a constant. Another very important thing to consider for this equation to hold is that if you are to look at the way we have talked about the barter system currently, we have asked ourselves, is it that it doesn't take place? It's still happening, that people can exchange goods for goods, services for services without necessary involvement of money in the country. And the number of transactions in regards to what we call the barter system have also to remain constant for the equation to hold water. In other words, for the equation MV is equals to PT, as under the quantity theory of money, under the demand for money, then those number of transactions under the barter system have not to increase, yeah? They have to remain constant. We have also talked about the government's policies have to remain constant. Any interference by the government needs not to change in the country. And those are some of the considerations that one needs to do in the discussion of the quantity theory of money. It's a common question. Take note. You may be asked to discuss about the quantity theory of money. Our theory number 2 is what we call the Keynesian theory of money. And this was represented by a modern economist known as the John Keynes. You'll see a lot of work done by John Keynes, even in our next topic, that is the national income analysis. Okay. So the John Keynes discussion identifies three motives. And I want you to take note about this very well. The John Keynes theory in regards to demand for money. Okay, we have got three motives that you're going to discuss. Why people would want to hold on to some money without actually spending it. There are three motives. Number one is what we call the transactional motive. One, we have the transactional motive. Some books, they call it the transaction motive, which is still okay. That is our point number one. Okay. Now, in the transactional motive, people would want to hold on to money, assuming you're paid your salary today on 1st. Within the 30 days, you'd ask yourself, how are you going to be meeting your daily transactions? So you don't want to spend everything on that 1st of the given month. You want to have some money set aside so that on your daily basis, you'll be able to meet, of course, your daily transactions. Maybe you're traveling from one point to another. Maybe you have got a family to feed. So in any case, you require to meet the daily transactions. So for transactional motive, people can even borrow money at whatever rate without actually asking how much is the interest rate, because on a daily basis, you are intending to, of course, meet as many transactions as possible. And in this case, we recognize demand for money as under what we call, in regards to the elasticity now, we would say people can borrow money at whatever rate, and therefore demand for money, and listen to this carefully, class. Demand for money as under transactional motive, we say it is interest inelastic. It is interest inelastic. You can even write that. This is interest inelastic, and not just interest inelastic actually. It is perfectly interest inelastic. Perfectly, write that. It is perfectly interest inelastic. Demand for money as under the transactional motive. This is a situation where you want to have some money somewhere, maybe in your account or even in cash form. You don't want to spend that money, but you want to feel it. You want to know that it is available so that you can meet your daily transactions. Therefore, as you demand for it, you don't mind about how much is the interest rate. You can borrow this money at whatever interest rate. And therefore, we say demand for money as under transactional motive is perfectly interest inelastic. People can borrow this money at whatever rate of interest so that they are able to meet their daily transactions. That is number one. Number two is what we call demand for money as guided by what we call the precautionary motive. Demand for money as under precautionary motive. This is a situation where you want to take a precaution. Tomorrow you may be ill, and so you don't want to have a situation where you have got no money to take yourself to a hospital. So you may keep a kitty somewhere in reference to you being able to take anything that is in reference to, let's say, emergencies, or just to be on a safer side, maybe for your kids' education as such. or maybe for yourself, you may put some money so that in the future, once you're done with your CPA, maybe you want to further your education. So there's some amount you want to set aside. So immediately you can enroll for another course to take a precaution. One may borrow money at whatever interest rate, which you may not mind as long as you'll have a way of meeting what we call anything that could be coming urgently. In other words, for contingency issues, you have been able to take care of that. And therefore, demand for money, class again, demand for money as under precautionary motive as presented by John Keynes is also perfectly interest inelastic. I repeat, demand for money as under precautionary motive because you want to meet something that is a contingency, for example, something that is urgent, maybe some illness or some cases where you want to take care of education matters. Because that is a must do and you must meet it, you might put somewhere some money that you have borrowed and you are not actually regarding any kind of an interest rate that was actually offered, meaning demand for money as under precautionary motive is also perfectly interest inelastic. Perfectly interest inelastic, meaning at whatever rate, you'll still borrow that particular money. Now, as we combine the transactional motive and the precautionary motive, these two are usually called the active balances. Demand for money as under precautionary and transactional motive, we regard them as active balances. And the demand for the active balances, we have said, is perfectly interest inelastic. These are called active balances. Usually abbreviated as demand for money as under the precautionary and transactional motive are abbreviated as MDT. We'll be using this abbreviation later on in our workings. I repeat, demand for money as under transactional motive and also precautionary motive are combined as active balances and abbreviated as MDT, not unless otherwise told. Number 3, we have what we call demand for money under the speculative motive. Demand for money under speculative motive. This is more or less a form of investment that one wants to take. I repeat, this is in regards to a form of investment that one may want to take in a society, meaning when you're borrowing money, you are careful in terms of the interest rate. This is not a situation where you rush for money at whatever rate. You are careful. You don't want to put yourself into a risk. And therefore, in any case, the investment is not going to give you a return, then you avoid even going for that particular loan. Therefore, under the speculative motive, we see demand for money actually increasing. The curve representing the demand for money for speculative motive is a downward sloping curve, which means that as the interest rate goes down, the demand for money and the loanable funds, in this case for speculative motive, tends to increase. That with a fall in the interest rate usually presented on the y-axis against now the quantity of the loan that you're borrowing, for example, in case you're doing it for the business purposes, you'd expect that if the interest rate is low, then the demand for that particular loanable fund will actually increase. So demand for money under speculative motive is said to be, class, this is said to be interest elastic. Interest elastic. That with a small change in the interest rate, we might bring a big change on the quantity demanded for the runnable funds. Interest elastic. I repeat, demand for money under speculative motive is interest elastic. And what happens is that interest and the quantity in regards to the demand for runnable funds now are inversely related. That as the interest increases, the demand for the runnable funds decreases. But when the interest decreases, then you find a lot of demand in regards to the runnable funds, because somebody doing it for business purposes, you'd expect a good return out of the borrowed amount. Usually, the demand for money under speculative motive is abbreviated as SP. That is the demand for money under the speculative motive. Some books, they call it SD, which is still okay. But in any case, the definition of the demand for money under speculative motive, it will always be highlighted. So demand for money now, demand for money. Demand for money as under the Keynes theory class is represented as MD, demand for money under the Keynes theory is represented as MD, and it combines the three motives, that is transactional motive and precautionary motive combined together as the active balances, MDT, and then we have the demand for money plus the demand for money under the speculative motive. And I hope that equation is clear for all of us. Demand for money by John Keynes, who has represented the three motives, is given by the active balances. Active balances, we have called them the transactional motive and the precautionary motive, usually abbreviated as MDT, not unless you're told otherwise. And then we have the speculative motive, which I've baptized as the MSP. And if told otherwise, again, you do the necessary. Now, when people are borrowing money, for whichever reason here that we have talked about, transactional motive, precautionary motive, we have said they won't mind about the interest rate. And now for the speculative motive, because here you have heard of a speculation, maybe a certain, like Safaricom is about to sell its shares, so you go grab some money from the bank in order to buy the shares by Safaricom. You see, that is a form of investment you're taking, so you're careful on the interest to be charged on that particular money that you're going to borrow. So demand under speculative motive tends to be interest elastic. Combining these three motives now to define the demand for money under John Keynes' discussion, we can represent that one on a graphical representation. Interest to be plotted on the Y. We have the interest here on the Y-axis. Against the runnable funds, the demand for money here. The quantity demanded. To be represented, say, on the X-axis. Now, we have said the transactional motive and the precautionary motive are active balances, and they don't mind about the interest rate. At whatever level, will still borrow that money. So in this regard, we have the demand for money, and when we are representing it against the interest, we find a straight line. Demand is perfectly interest inelastic. A vertical straight line parallel to the levels of the interest. At whatever level, you'll still be able to demand, let's say 20 shillings. You want to feel in your pocket at all times the 20 shillings is available to meet the transactions and maybe for precautionary motive. Okay. But now we have talked about the speculative motive where the interest level is actually declining. And so we find now the demand for money increasing. With a decrease in the level of the interest, the demand for money is actually increasing. But it will reach to a point where that interest rate cannot fall further and somebody is still borrowing the money. So as such is happening, we'll observe a horizontal straight line taken by our demand curve. That is when the interest rate now cannot go down further. For example, through the issue by the CBK, may find that the interest rate at which the banks are lending is said to be the lowest, can only be at 3%. So when we go down up to 3%, meaning we can't go further, people will still be borrowing money at that particular 3%. And of course, it will depend on the level at which somebody would want to borrow at the same rate. So when the interest rate now stands at the same level, but there is an amount that is still borrowed by the individuals in the country, you realize that the curve is now becoming flat as our demand curve. There is a demand curve as represented by the three motives. One, the transactionary and precautionary motive. We saw a case where demand was perfectly inelastic in regards to the interest rate, meaning a vertical straight line will be taken by the demand curve. In regards to how much we are borrowing, we are not minding about the interest rate. But now, in the speculative motive, because we have said this is like a form of investment that somebody is considering, you are careful about the interest rate. You don't want to invest where, let's say, the rate at which you are paying is more than the return. As such, you find that the demand for the runnable funds will increase, of course, with a fall in the interest rate. But it reaches to a point where the interest rate cannot fall further. Now, the portion representing the point at which the interest cannot fall further, this part of the curve, of the demand curve under the demand for money, is usually called the liquidity trap. I repeat, the part at which when the interest rate cannot fall further, as we represent that constant interest rate, liquidity trap, is a part that is representing the portion of the demand curve for the runnable funds under which the interest rate cannot fall further. And it's a very common question. Take note. I repeat, a liquidity trap is the portion of the demand curve for money, or for the runnable funds, under which the interest rate cannot fall further. That is, as the interest rate remains a constant. It was declining, but this is the lowest point to which that can decline. So as it stands at that point, any other amount that we borrow relating to the constant interest rate, meaning that the demand for money is actually, say, increasing, but with an amount of interest rate that is constant, that part of the demand curve is the one we are calling the liquidity trap. Again, as a small summary, the equation representing demand for money under the John Keynes theory is that demand for money combines the three motives, that is precautionary motive and the transactional motive, known as the active balances, represented by MDT. And we also have the speculative motive, which could be abbreviated as the MSP, or if otherwise told or given other abbreviations, like in an exam setup, you go for whatever will be given. And I hope that one is clear. Theory number 3, we have the Frenchman's quantity theory of money. And this now looks at the aspect of the wealth in the society, which now incorporates why people would actually demand for money. That the value of money is not only determined by the demand and of course the supply of money, but also depends on in which format are we able to put our wealth in regards to, let's say, what people want to see happening. If I take you back to the definition we had by Walker, he was talking about what money does. Yeah, what money does is what brings the meaning of money in the society. And I believe in our today's economy, that is the kind of a definition that many of us would be having. Whenever I work for a given amount and I've seen the effort made by that money, is what I'll come to appreciate as the money that I had. So out of what money does is the meaning that people will actually create in their mind. And in all these, people try to increase their wealth, yeah, by holding on to a given amount, by working hard so that they have a given amount, for example, acquired. So the expectation in terms of you, for example, investing on a given amount, let's say you have taken a business, you had borrowed money, that is what will bring a meaning to somebody, that if the return is higher on a given form of investment, then the demand for money would actually increase. Say you borrow money at whatever rate of interest, but you're assured of a higher return. Let's say if you're to do business, as a result of that higher return on an investment that you have taken, people would actually be driven to go for, even if it's a loan that I'm going for, as long as the investment is going to give me more, then I don't mind about that particular runnable fund. And of course, people demand money based on their desires in their lives, their tastes and their preferences. There are those who want to fail, let's say, being wealthy. And of course, they look for all sorts of ways in acquiring money in the society. So demand for money, as looked at by Fredman, is of course based on the issues of holding money so that one can feel wealthy. And of course, it depends on what kind of wealth are you looking for. Is it in terms of the human development? For example, I may hold money today because I want, like, after I'm able to complete my CPA, immediately I do a degree or I do another higher level of education. Such a way I'm developing myself career-wise. I'm trying to make myself better. That is a way of looking at money. Yeah, you want to have it today for future development in regards to your career. Or maybe you want to acquire, let's say, assets. You want to acquire properties. So if that is the definition you have as an individual, then you hold on to money, you look for money so that you can have those things that you'll feel they are now contributing to your wealth. Of course, there are those that would go for money because in the future, you look at it and you find you want to secure it. So you want to hold on to a given form of investment, not to be giving you, let's say, regular gains, yeah, but now looking at the future, when you age, for example, when you can't be able to work anymore, then you have an assurance of that your life is still taken care of, that you can be able to rely upon an investment that you took some years back and now it is going to reap you some fruits. For example, if you are to take a form of security, let's say in form of bonds, yeah, these ones by the government are likely to mature after a long period of time, during which you can say, this I'm looking forward to have a security, let's say after like 5 years, after 10 years, and so on. So people would actually consider holding on to money in different ways, in different views as to how they can actually be wealthy. Wealth could be determined out of assets that you could be having, out of the security that you're going for, especially for your future, out of, for example, your own development as an individual. Like for career development, this is so common that I would want to build myself, because when I have grown career-wise, even my future is already taken care of. So as such, you may find that people would actually look for money, of course, to bring a meaning in their life based on how they want to see the wealth associated with them. A bit of a problem that comes from the Frenchman's theory is that it may not be possible for somebody to measure wealth, especially like when it comes to human development, the career-wise development. Until one maybe gets the return, yeah, one may not be able to quantify the kind of wealth that we are talking of, yeah. Sometimes you may have such assets, and maybe because of the tear and wear, all assets would go through the tear and wear. Apart from maybe a land and maybe some buildings, if well taken care of, with their considered in terms of maintenance, they may appreciate. So many do depreciate. So how do you keep on measuring the wealth in regards to the theory as proposed by Frenchman? That may become difficult, yeah. It may become difficult. And again, because maybe the return is not a guaranteed one, we may not necessarily say that acquiring this money for you to have this form of wealth is actually something that is assured. But I think in our today's economy, I think this is where we can associate our thinking so much together with what we saw under the John Keynes model, that people go for money because it's something that they want to see happening out of that money. There's an attachment that they want to put. As much as you spend money, what has it done to you? And that is what really brings the meaning of as to why, for example, we are struggling every other day to look for this particular money, because it's something you want to see happening when you put that particular money into use. Supply of money on this other end, we are looking at what is that is in circulation. Full stop. I repeat, supply of money, just look at what is in circulation. What is bringing in people into spending, is that what we can call the supply of money. When I'm having my 10 shilling and you have your 5 shilling, another one has 100 shilling, that money, most probably by end of today, it will have changed hands, meaning it is part of what is in circulation. The concept of money may look difficult for somebody to associate with, but we try to narrow down how now the supply of money is interpreted in regards to a particular economy. Like in Kenya, the central bank would see supply of money in different ways. For example, any money that is held in our accounts, we may be having the savings accounts, we could be having current accounts. As such, that money as we speak today in the bank, most probably it's not idle. it has been issued this morning as a loan, or in whichever way it has changed hands. Within a short period of time, we see that money getting into circulation. By end of today, the person who took the loan went and bought an item, so that money most probably came back to the same bank. And in reference to how money would be circulating in the country, you see that there is a lot to mention in regards to the changing of hands from one point to another by that particular money. Again, we may find the foreign currencies which are getting into the country either by our own people from the foreign land or by the foreigners who are coming to spend in our country, or they are coming to buy some goods from us. As such, it's also part of what is in circulation and also contributing to the supply of money. The government securities and the non-bank kind of bonds and maybe treasury bills would also be involving the exchange of money at some point. So again, part of what is in circulation in the country. So we can mention about supply of money as to anything that is contributing to the circulation of money, the changing of money from one hand to another in the country. What determines the supply of money? Factors affecting the supply of money in the country. We also call them determinants of supply of money. I repeat, these are the factors affecting the supply of money in the country. We also call them the determinants of money supply. Number one, the government may work together with the central bank in the request of printing of more money so that it is able to support, for example, a budget that is at a deficit, or to some extent, we have got debts maybe to pay, so we may consider to print more money. A caution, remember, we said money is supposed to be scarce. So if we print a lot of money because we want to meet the government's needs, let's say our budget is at a deficit where the expenditure is more than the proposed sources of revenue by the government. If we print more money in reference to meeting a deficit balance of payment, what you'll find is that there will be a lack of the effort to carry economic activities. Remember, the feature about money is that it should be scarce. So to maintain that, that's why we don't see our government printing more money. In any case, we are still in debt. We would rather be so as to facilitate the activities being carried out in the society. The levels of the deposit by our people. The more deposit we make within the commercial banks, the more money changes hands. I'm introducing later on the bank we call the commercial bank, and we are going to see one of the major processes by the commercial banks known as the credit creation process, how commercial banks create money out of thin air. Your 20 shillings sitting idle in the bank, that cannot be idle because the bank will have given it out as a loan. And by the end of the day, maybe that money has come to the same bank like 20 more times. You go by, somebody bring it to the bank, another one comes and borrow it. Yeah, the process of credit creation, we'll discuss it further. Meaning, the more or the higher the level, the higher the process of credit creation by the commercial banks from the deposits made by their clients, the higher the money supply in the country. The rate into which we are having money supply will be higher in the country in reference to the deposits made by our clients. The government's expenditure. Our government is constructing the highways, the government is paying maybe more salaries to the workers or to the civil servants. So as much as the government is spending, that money is getting in the hands of the investors and it will keep on circulating in the country. So supply of money may increase with an increase in the level of government spending in the country, and the vice versa is also true, that if the government spending decreases, then that could also bring about a decline in the money supply in the country. Involvement in what we call the open market operation. Omo, how does operations in the open market happens? In the country, the government may sell securities to the mwananchi or to the public through the central bank. This can happen, say, when the government feels there's a lot of money in circulation. We are going to discuss about the monetary policies. One of it is the open market operation, where the government, through the central bank, may have felt there's a lot of money in circulation. So the government would request the central bank to sell the securities to the mwananchi so that we are able to capture, as a government, we can capture the money that the people of the nation are having. When we sell bonds, for example, to the citizens, bonds may be maturing after like 5 years, 7 years, 12 years. So that time long enough, the government is able to get hold of the money that was too much by the people of the country. And by so doing, people now avoid, or there'll be a decline in the level of spending in the country. Most probably, that money which was too high circulating in the country was bringing about an inflation we call a monetary inflation. To find a solution to that, the government may request the central bank to sell off the securities to the mwananchi, and by so doing, the government gets the money. The mwananchi is left with the securities. Of course, they earn interest on an annual basis, but in the process, the people of the nation will not be overspending that money. So if that happens, then supply of money reduces. On the other hand, there may be too little money in circulation. The government may request the central bank. It now buys off the securities from the mwananchi. Even before maturity, it may buy off the securities from the mwananchi so that the money is now with the citizens. And when the money gets into the hands of the citizens, there's a lot that will be circulating in the country. So when there is too little money in circulation, the government, by buying off the securities from the mwananchi, there'll be now an increase in the supply of money. Another factor is what we call the foreign currencies flow. The more we export, the more we get the currencies by other countries, and therefore our supply of money may be high. However, the little that we are able maybe to involve in international trade, for example, low levels of exportation, meaning foreign currencies are not a lot in our country, supply of money may be low. On the other hand, also, if we import so much, then it means there's a higher level of outflow of our currencies to other nations. It may mean that the country is likely to have low supply of money. And if we reduce the level of importation, like what we were talking of in our last class, through the restrictions in international trade, we are likely to have high supply of money in the country, because the outflow of our currency is likely to reduce. And if it is going to be spent within the country, then the exchange or the changing of the money from one hand to another may tend to increase, and that calls for a high supply of money in the country. A balance of payment that is at a deficit. Look at a country like Kenya. A lot of payments, say in terms of the imports, an outflow that is high. in terms of, let's say, our government has a meeting with another country's government. So when our people go and spend in those other countries for 5 days, there's a lot of the outflow that has flown to other nations. So in case we have a deficit balance of payment, supply of money is likely to be low, like in most developing countries. In the developed nations, you'll find that there is in the developed nations, they may have a surplus BOP. A surplus BOP, in our last class we said, is that which the receipts are more than the payments, which is a rare case like in our country, Kenya, which is a developing country. So for a developed one, since the payments are less than the receipts, it means receipts being higher, there's a lot of the inflows in the country, and this would help to increase the supply of money in such a nation. So those are the factors that we talked about as a way of maybe bringing an increase in the level of supply of money, or even lowering the supply of money in the country. However, there are other factors that we are going to discuss, but these factors, I'm going to put them as under the role played by the central bank in regards to the control now of the supply of money in the country. We call them the monetary policies. One of them is what I've just touched about, the open market operations, but we also have other factors that may reduce or help to increase the supply of money in the country. So these ones I'm going to discuss as under the regulation by the central bank as it operates what we call the monetary policies. We can stop there for today.